basic relationship in finance is the higher risk, the higher return. You see the relationship, risk-free asset, fixed income, equities, capital market line. And the empirical data matches this pretty well. Stocks are more risky than bonds. Small stocks are more risky than large stocks. There's this big payoff over time that small stocks outperform large stocks, and large stocks outperform bonds, and bonds are more risky than bills, and bills are a little more risky than inflation. And in fact, you get these huge payoffs where you invest $1 and you get these very large payoffs over the last 88 years. So these basically confirm the risk-return relationships. What I'm actually going to talk about, though, is going to be a little more disturbing from an academic perspective. But basically, it works like this. Across asset classes, we clearly have this relationship. The higher the risk and the higher return. But what is the profile within asset classes? Can you actually potentially get lower risk and higher return? And here we're going to see these rather unusual relationships. We're going to look at the top 3,000 stocks here. This is over the last 40 years. We're going to look at some characteristics within the equity markets, beta and volatility, value and growth, liquidity. And then we're going to put these portfolios together, risk and return portfolios by quartiles. Very simple. They're going to be rebalanced annually. They're going to be equally weighted. Okay, so the first one we'll look at here is beta and volatility within equity markets. So in theory, the high beta, high volatility stocks should outperform. And here's where we find our first kind of big puzzle here. Actually, the low beta stocks, and these are ranked from the year before, the low beta stocks actually quite dramatically outperform the high beta stocks. And this is not just a short period, it's over a 40-year period. And then if you look at the volatility measure here, the low volatility stocks have outperformed the high volatility stocks. And of course, it's the high beta stocks that have the higher standard deviations, measure of risk, and it's the high volatility stocks that have the higher standard deviations. So this is something that is very counter to theory, that we've actually had this result over 40 years, that the low beta beats high beta, and low volatility beats high volatility. All right, now let's look at another one. This is size. Here we come up with something pretty strange. Again, if you measure size by some other criteria other than capitalization, but if you rank them by their assets or rank them by their revenue, or if you rank it by income, all of these categories actually come up with a pretty astounding result here, that the small cap premium doesn't seem to be the case when measured by something other than capitalization. In fact, the large companies, the large asset firms, somewhat outperform the smaller asset firms. We'll take another one, the value versus growth here. So all of these things, there's clearly a value premium in the market here. What's surprising now, though, is that the value premium isn't necessarily a risk premium. It's always been called a risk premium. But if you look at the risk of the value premiums, it turns out that which has the bigger risk, it's usually the growth number is the ones with the bigger risk. Okay, here's another one, liquidity. The less liquid stocks have higher returns than the more liquid stocks. Turnover gets a similar payoff, actually bigger. Turnover is a measure adjusted for size that tells you to what extent the stock trades relative to its size. And the lower turnover stocks have much higher returns than the higher turnover stocks. What's different about these two, well, the turnover is a bigger number, bigger spread. It certainly makes sense that less liquid stocks should have higher returns than more liquid stocks, because less liquid stocks are less desired. You know, the prices are going to be depressed. because of being less liquid. And if you buy something that's relatively depressed in value, it's going to have a higher return. Basically, it has a higher cost of capital. Well, what's strange here, though, is in the standard deviations. Ahmad, you notice, the less liquid stocks by that measure has a higher standard deviation. But by the turnover measure here, there's actually a lower standard deviation. So we puzzled over that for quite a while, the fact that these things work in such opposite directions. What we're really getting at here, we think, is this gets the notion of popularity. In fact, a low turnover stock might be very liquid. It could be a big cap with relatively low turnover, but very liquid. Might have low price impact. But low turnover means there's not so much trading interest in it. It might be a measure of popularity. But there are various ways we can put things into quartiles here. So we actually put, there's actually, on all these combinations, there's 84 different points here. Now what's pretty apparent here is it's not following the line that it's supposed to. We imagine that we get this relationship here between risk and return. If anything, this looks like quite the opposite. So we're saying things don't seem to work within the stock market like they work across markets. We weren't necessarily trying to find this perverse risk-return relationship. We were actually trying to find out what works best. These are the best quartiles here of every category. And what works best, actually value works best, I guess, and it's the purple ones here. But these turnover measures are really right up there with them. Beta measures on some of these work best. Some of these other things that work pretty well were low beta, low volatility, but it's supposed to be high beta, high volatility that works. Small caps tend to work, but not small companies, high momentum. After you risk adjust it and you drove through the capital market line, less popular, low volatility, low beta do well. Value doesn't do quite as well because its risk is higher. Okay, now one of the things we wanted to do is try to get some explanation for some of this. Because we're essentially going to give you an overall popularity explanation here. Now, why do these premiums exist? Are they risk premiums or are they popularity premiums? We're saying is this leads in some way to popularity. Some things become overly popular, some things become less popular, and ultimately we're saying these premiums could relate to popularity. Now clearly, let's start at the bottom. The liquidity there, that's pretty obvious. Liquidity is popular. Everybody wants the most liquid thing, and they'll pay more for it, and that should have a premium attached to it. Value turns out to be unpopular. People seem to like stocks that are exciting. They like the growth stocks. They like the stocks that have stories about them. They like interesting companies. These value companies, if you actually look at who they are and all that, they're kind of boring companies. They're companies that they have a lot of earnings, they have a lot of book value, but they are not necessarily the best run companies. One of the reasons it might be that value ends up beating growth is it's easier to improve a badly run company than a well-run company. But these value companies are not the wonderful companies. There's usually something wrong with them. And they're unpopular, we're saying here. And so we're saying these premiums might be associated with lack of value premium, value is unpopular, the less liquid is unpopular. So something will always be unpopular, that's the key. Right. It might change over time. Some things may be permanently unpopular, like less liquidity, but other things may just be changing all the time in popularity. So, I guess the key to popularity is it's a measure here that something's always unpopular, and if you go after the unpopular things, we're saying you're going to get the better returns.